G'day folks, Seeney here. Welcome to another episode on the Australian Wealth Channel, and today we're going to talk about why Robert Kiyosaki is wrong. So thank you guys so much for tuning into this video. Please make sure you like and subscribe to the channel. Really helps to get these videos out to more people. So in this video, we're going to be talking about Robert Kiyosaki and why he is wrong in this particular instance. So anyone that doesn't know Robert Kiyosaki, he's a very well-known speaker and also the author of Rich Dad, Poor Dad, which has some incredible stories and some incredible ideas for what it means to build wealth over time. There's certainly a lot of knowledge to take away from this particular book, and I think there's some great stories in there. But there's something that I wanted to clarify about Robert Kiyosaki's position. Now, let me explain. Robert Kiyosaki has talked about what an asset is and what a liability is. So, in simplest terms, an asset is something that is paying you to own it. So I'll say that again. An asset is something that is paying you to own it. So this is something like a positively geared rental property. So that is where you're making more money than what you are outlaying in a mortgage, or maybe it's a dividend stock that is paying you a 4%, 5% return every year just for holding that stock. That is something that is putting money into your pocket. In Kiyosaki's definition, that is an asset. On the other hand, we have what is called liabilities. Now, a liability in Robert Kiyosaki's definition is something where you are paying money to own it. So that is something like a car. A car would be a liability. You know, it's depreciating in value over time, and of course, you're having to fuel it up if you want to get anywhere, or charge it up if you have an electric car. Or it could be your primary place of residence, somewhere that you are paying a mortgage plus rates and all of these extra expenses to be able to live in it. In a nutshell, a liability is holding anything that is taking money out of your pocket. According to Kiyosaki, the big mistake that the poor and the middle class make is that they spend their lives buying liabilities instead of assets. As a general principle, this is correct. However, not entirely, and let me explain why. In Robert Kiyosaki's eyes, our primary place of residence would be a liability because you are paying a mortgage on it. You know, you're borrowing money and you're paying interest to the bank. So this, by definition, in Robert Kiyosaki's eyes, makes it a liability. However, this is where there's a bit of a shift. Now, in the last 12 months, the capital growth of our property has far outweighed the interest payments that we've had to make. So our liability has appreciated in value far beyond what we've been forced to lay out. But of course, home equity is useless unless you're actually putting it to work. So this is where, even by Kiyosaki's definition, our home, which is technically a liability, now becomes an asset due to appreciation. We have the ability to pull out over $150,000 in equity from our property to go and invest in additional investment properties, which will generate a return and pay us to own them. And the best part is, we don't even have to dip into our own capital to do this at all. It's basically free money to invest. So what this means is that our so-called liability is giving us cash for free to generate further returns. And this is all thanks to the capital growth of our primary place of residence. It is our liability that's allowed us to get hold of more capital to go and invest in additional properties which are going to get that cash flow and that return. So it's a couple of step process, but technically under this definition, our primary place of residence, which we are paying to own because of the mortgage, is actually paying us money. So this is quite an effective strategy for building wealth over time. Of course, as this property continues to grow in value, that means that we can borrow more money against it to go and purchase additional properties or stocks, things that are going to pay us money to hold them. So I'd be really keen to hear your take on this particular situation. Do you think that Robert Kiyosaki's definition is correct? Is an asset something that pays you? Is a liability something that's taking money away from you? Even if you're using it to go and generate additional income elsewhere, there's another step there. I'd be really keen to hear what your thoughts are in the comments. So please make sure you like and subscribe to the channel. It really helps to get these videos out to more people. So thank you guys so much for watching. We're putting out videos every week, and we will see you later.